Yes, so before we proceed into this particular question of Shaurya Limited, because previously if I had have told you certain theories, it would have become pure theory because we discussed, so I rushed some portion, and that there is one big confusing portion called the PPE. Okay, now we will spend time because now fairly have you understood the transition? Yes, now it is the time that we have to focus on that PPE related adjustment, because that adjustments are going to come here now in this particular question. Okay, now let us have a recap and we will go to that particular area where we were speaking about the deemed cost. Okay, so we were discussing about one by one items here, correct? NCI, business combination, government loan. So the deemed cost of the PPE. Now what does it say? You understand now in detail. First thing is in simple. Do you want a simple life? Take whatever your previous, one option I will give it to you. Take whatever your previous book values are there as per your standards. You continue as it is as a new book values. If you are doing revaluation, you continuing doing with the revaluation. If you are following cost model under accounting standard, because the cost and revaluation was permitted, no? You continue with that cost model. No, alternatively, no sir, I don't want that simple option. Then you should do for everything, not on selective basis. No, I want to do it on a selective basis. Then standard says that, look, you have to apply retrospectively. You can measure, entity shall measure the items as per respective Ind AS 1638 and 116 retrospectively. And this measure can be applied on item by item basis in a class. That means everything I need not do retrospectively. How it will work? Like for example, plant A, I can measure retrospectively. Okay, a separate class plant B, I can apply fair value, and that value I can say retrospective value, because if it was whatever it was value today, it would mean it's fair value. Or I can go for a revaluation option. I can shift now. I can jump. So there is one beautiful options are also given. Followed, no? So this is what I mean to say here in this picture. When you do it, say you have got one PPE. PPE can have a land, building, plant, build, equipment. One thing is entire PPE you take the previous value as a new value. Or something you choose to go retrospectively from the day you acquire and check what would have been its balance on this transition date. Difference should have gone to retained earnings because of the depreciation difference or whatever. Because you must have added something which should not, like decommissioning liability should have added, you didn't do it as per accounting standard. Now as per Ind AS retrospective means you on day one you go and add the decommissioning liability, check the cumulative depreciation, all those things you would have done. Then on the other hand I would have taken something as a fair value. Chalo, land we will value it on a fair value basis. Because land is not a depreciable item. So I will simply take that fair valuation today, and that this I will continue going forward. It's an item by item basis. And something I will shift into revaluation basis. See, revaluation basis is different from fair valuation basis. Land, it doesn't matter me because I don't charge depreciations and all. So cumulative, they have given me an option to take it to the retained earnings. But other items, you have to go into revaluation because it is subject to revaluation surplus there. So this is what you need to do. Fair value measurement, and this also I can apply on item by basis. Like I can do something on revaluation, something I need not do it on revaluation. Now what about the previous gap revaluation? The previous gap revaluation can be item based, with item basis I can apply if such revaluations are broadly comparable to the fair value or cost less depreciation as per Ind AS adjusted to reflect the changes in general or specific price index. Okay, I will explain this particular concept here. What they are telling me, like previously you are following revaluation. You want to continue with that revaluation. Can you continue with that values only? That's what they said, that if it is comparable. Otherwise you have to find out a new fair value today. Otherwise for the Ind AS sake you don't carry out a separate exercise. If it's somewhere comparable to the cost or depreciated cost, then you could have continued it. Now previous carrying amount, okay, alternative option of, this is option number 1. These are all coming, these first 3 are coming option 1. In option 2, which is point number D. I will tell you, adopt as a deemed previous cost what all your previous valuations were there. This measurement option can be applied only if to all the assets, classes and items and not on selective basis. Now, any fair value increase in the PP is recognized in the revaluation surplus in such case. On change from the revaluation to cost model, revaluation surplus is going to be retained into retained earnings, because already some revaluation surplus was there. You will transfer it to the retained earnings. Which one? Fair value increase means it's like a revaluation, no? Any fair value increase in the revaluation surplus means okay. That's what that part I will explain here. In the deemed cost also, okay, maybe no. This sentence I may have to remove. Any fair value increase is not going to come here. Okay, because if you have gone, then you would have taken the previous values. Okay. Now, any changes from the revaluation to cost model. Now, at this point of time, okay, or I can include it like this also. You want to continue with the previous values, and you want to shift from cost model to revaluation model. Then, can I stop you from that? See, one thing is you want to take the previous values, but what if you want to shift from cost to revaluation model? That I cannot stop you, no. That any point of time you can do it. Today also you can do it. After 2 years you can do it. That's your accounting policy choice. So there is one challenge comes that when I have taken everybody, one item I want to shift from cost to revaluation model. So if I am going to shift to cost to revaluation model, then the revaluation surplus is going to come into picture. Which one? It will go into the retained earnings. And again, see, this is only one exception. Generally should go to revaluation surplus actually. I should show it separately. But you show revaluation surplus separately or you add it in the retained earning, the effect will be almost same. No? For the dividend sake, yes, it is different. Because only when you realize you should transfer. Because if we see, again, for me also personally, if I see, there is one inconsistency in the previous question. In the previous question, the land was revalued. And what did we do? We transferred it to the retained earnings. But actually, I was supposed to transfer to the revaluation surplus. That they have not done. Okay, so keep this in mind. If that reconciliation problem comes, you need to see, alternatively, you can treat it as a revaluation surplus also. Followed, no? In the previous question. But what they have done, they have transferred to the retained earnings, keep that. But in the new question, what we are going to do, they have done a proper adjustment about the revaluation surplus. Now, if you shift from revaluation surplus in the retained earnings, and if you want to shift from revaluation to cost model, then I don't need revaluation surplus anymore in the balance sheet. Transfer it to the retained earnings because you have shifted. Now, entity can allocate the cost of the component based on the fair value. Like suppose you want to continue with the cost component accounting now. Accounting standard, you are not doing component accounting. So what you can do is you can start doing component accounting. How? You need to pass one accounting entry now. What is that accounting entry? PP to PP, but you will recognize one new component. From general PP, you will credit, new component PP you are going to debit. And that component PP you will depreciate faster. What is the value of that component? Fair value on today's date, on the date of transaction. And from now onwards you depreciate. However, different entities in the group can choose different basis of arriving at a deemed cost on a standalone. That means some at a group at a standalone level, one subsidiary can take previous value as my deemed cost. Another subsidiary can say, no, I will do retrospective, I will do revaluation, fair valuation and all they may say. In a consolidated statement, everything should be one reporting entity. You cannot do this different. That's why generally what happens, no, parent will instruct every subsidiaries, follow my method. If I go for deemed cost, every one of you should go for deemed cost. If I go for selective restatement, like class to class restatement, then you should also do it class to class restatement, because at the CFS level it should be same. So this is what two options are there. One, previous value you take as it is, or item wise item you can do fair valuation or retrospective restatement. Now you understand this example. Okay, so this should give you much clarity about what that all about. Now option 2, take the previous accounting standard, and this is a carve out. Okay, this is different from what IFRS says. This is for our Indian scenario. We are deviating from IFRS. Now option number 1, what is that? We go for retrospective change. Previously you have been under cost model. Under new also you opted for cost model. But your option was retrospective. Retrospective means every single item you will think, what should I do now? Should I do retrospective or should I do fair valuation right now? Now previous also it was cost model, this also cost model, you will say retrospective. So what difference will come? Generally that decommissioning liability type of thing, some cost you charge to P&L account should have come into balance sheet as per Ind AS 16. So such type of differences will get loaded and you will calculate the new book value, it will get depreciated, and that depreciation difference during all these years you will transfer to the retained earnings. Now what if from cost model you want to jump into revaluation model? The standard says it is not a change in policy, because even though I call it change in policy, this is, you would have come to the today's fair value. So revalue at a fair value on the transition date. Okay, I'll give you one advantage. Don't find out the fair value then, because you wanted to shift from cost to revaluation. No, I'll give you one benefit to you. Don't you find out fair value on today's date, check its book value and transfer that excess amount to revaluation surplus. It is more like your Ind AS 116 alternative 2, like retrospective, but from today. From today onwards, transition date onwards, this is a revaluation surplus, and going forward, you do the revaluation as it is. Are you clear about these two things? Now you are under revaluation model. Now you don't want revaluation anymore. You want to come under cost model. What it is? What do you say? Can you come? Yeah, that also I can come any point of time. The standard gives you one benefit. They say that, look, take this advantage. Again, don't get into restatement here from retrospectively. It is also not a policy change. Take the previous revaluation balance as a deemed cost. Otherwise, if it was a cost model, what is the retrospective restatement? You should have gone to the day one, taken the cost of it, and find out what is the cost today. Difference between that cost and the revaluation cost should have gone to the retained earnings or reserve revaluation surplus, whatever. They say that you take the previous revaluation as a deemed cost, and from now onwards, okay, provided it is comparable with the fair value, and from now onwards you continue with your cost. From now onwards, don't restate it, because you are now more in cost model. Previously you are under revaluation model, means from the day, from 1990 when you acquired the asset, no, every 3 years you are restating at the revaluation amount. You acquired at 100 rupees, but you have been revaluing it from time to time. So today its value may be 150 rupees, and 50 rupees must be in the revaluation surplus. Your accounting entry is revaluation surplus, no, you have been accumulating in revaluation surplus. The standard says that, look, instead of restating, like going back and finding out the cost and charging depreciation from then and checking what is the depreciated cost today, since you are you want to take an advantage, no, and you want to convert yourself into cost model, yes, you simply convert today only. Whatever is the book value available here, you treat it as a cost, and from now onwards don't restate anymore. And if, since you shifted to cost, there is already one revaluation surplus sitting, you transfer it to the retained earnings. Now what if you wanted to continue with the revaluation model only? You have been doing revaluation and you want to continue with the revaluation, but question comes, when did you do the previous revaluation? Sir, I did 3 years back. When you are transiting right now, can I take that 3-year back revaluation value, or should I do revaluation right now on the date of transition? Because I have opted for retrospective, no, I didn't opt for the previous value here. If you tell me take the previous value, then I should have taken all the previous value. Like this type of one cost, one revaluation with retrospective cost, that I cannot do. Now only question is, can I take this revaluation 3-year back value as my cost? That's why first they say, yeah, for this you have to understand the scenario. See, if your revaluation was, say for example, 2-year back, and you want to shift to cost model, the standard says this 2-year back value, instead of 5-year back cost, you can take 2-year back fair value as a deemed cost if it is comparable with the fair value on the transition date. So if this 2-year back fair value is equal to fair value on transition date, then instead of going back to that 5-year old cost and do retrospective, because you wanted to shift, no, you can take this value and continue. Which one? Here cost model. That's what they say, not required. If it is somewhere comparable with the 2-year back fair value, because already you have done one fair value exercise. Transition date, yeah. I should know, okay, but if it's or cost, they said, no, or somewhere if it's comparable with the cost. Again, see, if you ask me, it's a very detailed subject. If you open this textbook, you understand how deep it is. Okay, let us just take the more from the examination point of view. Okay, what they say, that you understand that revaluation to cost model, it should be just comparable. Okay, really whether we carry out that exercise or not, that is the different story. If that case, yes, you can take this value and I will start with the value. See, comparable means again is the judgment. If I don't know my fair value today, maybe I can check the cost. Is it such a big difference? If it's a so big difference, then I will not take this. I would have gone to the restatement from the beginning. Or I would have taken a new fair value today. And from here I would have continued. If there is a big difference, I would have continued from here. Or I can say like this also. I can also alternative say like this. See, because of the transition, I will take fair value today. But if there is no much difference between 2-year fair value and today's fair value, they have given me an option to continue with the 2-year fair value and not to pass any more differential accounting entries. It's a small amount, no. Ignore it, immaterial, leave it. But if it is really different, then take today's fair value and continue. Okay. And since you go cost model, you don't need this revaluation surplus, transfer to the retained earnings. Now one more thing comes. You are already done revaluation previously and you want to come here. Okay. Now again the same story. Can I take that 2-year back thing? Yes, if it's comparable with the fair value on the transition date, somewhere small difference, you continue with the previous thing, because again restatement of depreciation elimination is going to come into picture. You have to or your proportionate cost method, so many work is involved, no. Now see, for you simple is what? Simple is take the book value is simple, or pass one accounting entry is simple. Take the book value is simple, no. That's why they said, see, and it is not one PP, there will be so many items. So you carry on the exercise for all the items of the PP. If it is somewhere comparable, that immaterial thing, don't pass any new accounting entry, because it requires more work now. Restatement, extra provision, find out the percentage, or eliminate all the previous things. So many things are there, no. You ignore it, and it works like this. Take previous book value, continue. Where? If you, here, if you take the difference between this and this, obviously, this will go to revaluation surplus, because already revaluation surplus is sitting in your balance sheet. This revaluation was 100 rupees and today's day 110 rupees. You apply, first time adoption, you will do it. But if you see that, look, as per your judgment, it is not material, you ignore this and you continue with this. But if you say, sir, this is very, very material, 10 rupees I cannot leave, then you will pass one new accounting entry. What is that? PP account debit to revaluation surplus. And my 50 rupees will get added with the 10 rupees. Followed, no? This is okay? Now fairly understood what it is? Okay, so there can be more students. See, I am explaining you only from the point of view on, there is one theory question on this under new syllabus, I believe. So you have to answer that. For this answering, you have to understand this transition cost to this under both options. Yes, so now keeping this in mind, we will come back to our Shaurya problem. Shaurya Limited, and see, full attention here because lot of adjustments are there. Shaurya Limited is in the company having a registered and a corporate office in New Delhi. 60% of the shares are held by the government of India and rest by other investors. So this is the government company now. This is the first time that the Shaurya would apply the Ind AS in preparation of the financial statements of 1920. So what is my transition date? 1st April 2018. That's why they said give me the balance sheet of 31st March 2018. So as per earlier gap, maybe accounting standard, they gave you one balance sheet. Yeah, share capital, reserves and surplus, non-current, current. Okay, financial liability concept is not there. But under accounting standard, we have Ind AS, we have got a financial liability. Non-current assets, PP, one mistake they said, they should have told fixed assets. Intangible asset, goodwill, non-current investments and current investments. If you see financial asset, not applicable, not seen only. Now additional information. Now the catch you see here, these informations are given in absolute values. Now they have told you rupees in thousands. In thousands, okay, sorry, I see. Okay, this is also rupees in thousands. I missed it. Now other current liabilities, please check now, check back as and when we read this. Open the balance sheet also. Other current liabilities include 3,90,000 rupees liabilities to be paid in cash. So what is your other current liability? How much is the total other current liability? 1 minute. Other current liability 4,50,000, correct? Now have they given me the breakup of 4,50,000? Yes, they have told me out of that 3.9 belongs to paid in cash such as expense payable, salary payable, etc. 60,000 to government dues. Why? What is the difference? Non-what? One is, both are current only. No? One is financial liability, another is non-financial liability. Which is non-financial? Government is non-financial. So when you present now Ind AS balance sheet, one reclassification adjustment should happen, which is not going to hit your retained earnings. Retained earnings is not going to hit. It's not going to hit, no. That's what I told you. It's not going to hit the retained earnings. It's like some land to investment property. Followed? Then long-term loans, and so you have to remember now, from there, one shift has to happen. Now the long-term loans and advances includes 40. Loan, okay, what is your long-term loans? And the remaining amount consists of advance to staff 1,10,000. So how much is your long-term loans? 4,50,000. It includes, sorry? Long-term loans and advances on the asset side is 1,50,000. They have given you the breakup of 1,50,000. So what is the difference here? Long-term loans and advances 40,000 loan and remaining advance to staff. Is here as per schedule 3 format, the loans has to be separately shown from your advances. You cannot club both. Now other non-current assets, how much is your other non-current assets? 2 lakh. Consists of capital advance to suppliers. What is this? Non-financial. Advance to staff is financial, no? Advance to staff is the financial liability, no? Financial asset. if I have to, then also it is no cash, no. Otherwise, I have to pay the cash, right? Which one? Are they not going to refund me this back? Principal, are they not? Have you not done in Ind AS 109? Loan given to the employees at a 0 rate of interest or concessional rate of interest. So it's a financial asset for me. Followed, no? So these are non-current, non-financial assets. So heading is going to come like this: financial assets, non-financial assets. Current, non-financial, current, non-current, non-financial. So this is the only confusion. Otherwise, this problem is a very simple problem, because this gets the flavor of Ind AS 1 now. Current and non-current classification. And that's what, no, in analysis of the financial statement also same problem you are going to face. Not a problem, it's like new way of current classification. Now other current assets include 3,50,000 receivable in cash and a prepaid expense of 50. So how much is the other current assets? 4 lakh. Out of this, 3.5 is the current financial, 50 is current non-financial. Because schedule 3 format we have to give. Short term provisions includes dividend payable 2 lakh. And they have board meeting was done and declared a dividend of 27 made. However, the subject of shareholders approval is pending. What you should do? Reverse. So this adjustment is going to touch your retained earnings. And all other previous was the reclassification only. It is not going to touch your other equity balances. Any reclassification from your other equity to this, it would have been part of your reconciliation statement. Like preference share capital was sitting in other equity. You classify as a financial liability. That is going to hit your other equity. But anyhow, we need not do this. Let us see what they are expecting. Now the CFO of Shaurya presented the following information of the corresponding figures. They said that the property, plant, equipment consists of class of assets as office building whose carrying amount is 10 lakhs. However, the fair value of the office building on the date of admission transition is estimated to be 15 lakhs. Now, probably they wanted to make one, they don't want to go with the previous book value. There are only two options. One is go with the previous book value, but it is not just 10. How much is the total PP? Total PP is 20. 20 has got a 2 breakup now. 10, 10. Now, by the way they have given information, it sounds like they don't want to go with the previous book value. They want to restate this. If they restate this, they should restate others also. Either retrospective restatement or a fair valuation. Now, company wants to follow revaluation model as its accounting policy in respect of property, plant and equipment. So, reasonably we will assume that previously it must have been under a cost model. Otherwise, somewhere in the balance sheet you should have seen revaluation surplus there. Not there. So, what we will assume that 20 was under cost model. I don't want to take 20 as it is. Then I should have taken 20 for both. Out of that one I want to revaluation. So, I want to shift from cost to revaluation surplus. Can I do that? Yes. That 5 what I will do? Revaluation surplus I will do. OCI. What about the balance 10? I will assume revaluation followed, but its cost was equal to the revaluation value. See, out of 20, I will do revaluation 15. But will standard permit me selective basis of revaluation? I will continue with the cost of the balance 10, do revaluation only for this 10. Item wise item what? It is a retrospective, no? I should have gone for, if you want to continue with the cost model, retrospectively you should restate. Or you can do revaluation here, retrospective here. Now, I have to make an assumption for the other portion now. See, one portion is very clear. One thing is very clear, that option number 2, previous gap deemed cost is not adopted. Agree with me? Because they said very clearly that company wants to follow revaluation model. That means all the assets previous book value, I cannot take it as a new book value. Agree with me? Yes. Now, when I take one item revaluation, then I am left with no choice other than for the other item. Either you do retrospective or you do fair valuation. That means I should do either retrospective or a fair valuation, correct? No, means I cannot take its previous book value to today's book value. Either everything you should do. Now what I have done for the balance, information is very silent, so I can either assume that I have followed the cost model retrospectively and its balance is same as like this. That means 10 is equal to its retrospectively restated cost, or I have fair valued it and its fair value is equal to its book value. Perfect. This is the catch, and this is the confusion. Otherwise everything is fine, and for this you have to understand that particular thing. Yes, clear? Yes. So next, the fair value of the intangible assets as on the date of transition is estimated to be 2,50,000. However, the management is reluctant to incorporate the fair value changes in the books. Can you do this? Not all assets, no. It's the class of assets. PP, inside PP you cannot do that, but intangible asset is a new asset only for you. Which one? Why? You want to continue with the previous cost, no? Whatever values were there, the fair value of intangible asset is so and so, but I just want to take the previous value. Can I do it now? Whatever we have spoken now should be for that class, not for other group of assets. Yeah, clear, no? So it's all for all the PPs, not for all your assets. Like for that, have you not for business combination? Are you restating? No, you have got an option not to restate, no? So you are clear now here. So here it will go to revaluation surplus. So deemed cost is permitted for your intangible asset. Under intangible assets you have got a breakup now. Mast, these publishing heads as per schedule 3. There every item should be as per the previous. There you don't tell me, sir, publishing rights I will revalue now. I want to follow the publishing titles revaluation model. So under that there is a class of assets, no? Under intangible asset, that everything should be one. Because these are all the major heading in your balance sheet. Building is PP. So under PP what all things comes, everything should be either you take the previous or you adjust the, you go with the fair valuation or revaluation, retrospective or revaluation. That is one. Class is individual items in the class, no? See, on the face of the balance sheet, what all things you have got? You have got a PP. Is intangible asset included under this or it is shown separately? Investment property, is it included under PP, shown separately? Now investment property, anyhow, there is no option of your revaluation there. Okay, but intangible asset is separate from PP, no? So for intangible assets you have got this option that take all the previous deemed cost. Clear? This part is clear, no? Next, Shaurya has acquired 80% shares of the company Excel Private Limited few years ago, thereby acquiring the control upon at its time. Now Shaurya recognized goodwill as per the accounting standard by accounting the excess of consideration paid over net assets acquired. The fair value exercise was not done at the time of this exercise. What to do with now? You understood what happened? So what we will do? Can you see any goodwill or anything is there in the balance sheet? No, am I going to restate it? Is that goodwill correct? No. Correct as per accounting standard. Otherwise, the auditor would have given a qualified opinion then, no. But your index says what? You are on 103, you need to recognize the assets at the fair value. But what did you do? You must have taken at a book value, or God knows what you have done. Fair value exercise was not done only. Now, only question is, will you take that goodwill as it is? Why? Because there is one option, not to restate the goodwill, not to restate. But if you restate one goodwill, then you have to restate all the business combination. Your entire balance sheet is going to change now. Instead of cost and all, your fair values are going to come. Current is already at a fair value. Non-current is going to change. Next comes the trade receivable, includes an amount of 20,000 as a provision for bad and doubtful debts. measured as per previous gap. Now as per latest estimate, it is 25,000. Are you going to change this difference? No, it is the change in the estimate. No, it is prospectively applied. From now onwards, it is going to get changed. Means in the opening retained earnings, it is not going to affect. Trade receivable, how much is the book value in the balance sheet? 9 lakh. 9 lakh includes one debtor of 20,000 rupees. The provision, okay, trade receivable includes the amount of, this is after 9 lakh 20 is net of provision. Sorry, 9 lakh is net of provision. Do you know how much provision is sitting? X amount of provision, we don't know. Now in that provision, there is one provision for 20,000, which should have been 25,000 today. Followed, no? Debtors balance, okay, trade receivable is some X balance minus RBD Y. This gave you 9 lakh. But this Y has got one item which we don't know. How much is total Y? We don't know. That one item's value is 20,000. Is this correct? No, this should have been 25,000. That means your estimate was wrong. Will you adjust it to the retained earnings? No, prospectively is going to come. Followed, no? So it can only change in the next, in the comparative period you will charge to the P&L account. Standard tells how can, if your estimates how it can different, your accounting treatment can be different. Now company had given a loan of 1 lakh rupees to an entity for a term of 10 years, 6 years ago. The total loan period was 10. How many years are pending now from transition date? 4 more years. Transaction costs were incurred separately on this loan, and the loan carries an interest of 7%. Principal amount to be repaid in equal installment over a period of 10 years at the end of the year. Now the interest is also payable at the end every year. Now this is like a non-conventional bond. Now whether it is at a market term or not market term, we don't know. The fair value of the loan on the date of transition is 50,000 against the carrying amount of the loan which is present 40,000. Now how did you get this 40 as per the previous accounting? However, Ind AS 109 mandates to charge the interest as per effective interest method. What they must have done? They must have charged interest at the rate of 7%. But what you are supposed to do? EIR. Now, what is that EIR? We have to find out IRR now. And we don't know whether it is at the market or off market. It's a conventional, but principal amount to be paid in equal installment, no? So the moment you say equal installment, you have to pay. In conventional, what we will treat? Only principal paid at the end of the year, no? Because for this first step is to calculate the cash flows. Now, after the transaction cost also is there, which is got to be adjusted. But I don't know what they have done. This transaction cost they must have charged to P&L account instantly. In short, the loan balance should have been different as compared to today. This, can I take this? Is this balance as per Ind AS 109? No, because here interest is charged at the rate of 7%, and the transaction cost they must have charged to P&L account. What I would have done? I would have charged interest with the change in the EIR. My EIR would not have been 7. For time being, let me assume that it is a market rate. If it was at a market rate, what is my EIR? 7%. What I would do with this transaction cost? Adjust with this loan. The moment I adjust with this loan, my EIR is going to change now, increase. This is what I would have done in Ind AS 109. What they did? They must have charged to the P&L account, and they have charged interest at the rate of 7%. So 109 mandates to charge the interest as per EIR after adjustment of the transaction cost, because you are showing loan at amortized cost. Clear? Management says it is a very tedious for us to apply the effective interest rate at this point of time. Hence, they are reluctant to apply the same retrospectively in the first time. They say that, sir, it is very difficult for us to Do it from the beginning and find out by adjusting EIR what would have been balanced today and take this difference. So Ind AS says that same loan of point number 2 of additional information of if EIR is impracticable to go with the current, you can take the current fair value and difference in the retained earnings you can calculate. You can start with the fair value today, find out the new EIR, and going forward you charge it to the P&L. This is one option given for the financial instrument. If in the long term borrowings of 4,50,000 component, okay, you have got a long term loans and advances or borrowing, where is that? Non-current liability, long term borrowing. This one component due to the state government. The interest is payable at the rate of 4%. However, prevailing rate of interest is 8%. The fair market value of the loan is 4,20,000. So what you will do with this? Is there any option for you? What you are supposed to do? What standard says? Prospectively. Ind AS 109(20) can be applied prospectively. Okay. So if you want, you can do it retrospectively. This is the third problem we are solving. First problem we solved prospective. Second problem we solved with the retrospective. But that retrospective was very easy because it was just one day before. Here we don't know when the loan was taken. Okay, they didn't tell me anything. So we will decide to go prospective. No, if you have the information with you, you can split. No, prospectively you need not split that. No? Which one? We'll see that. We'll see whether what they have taken, we don't know. So can go with the previous carrying amount if they want to apply prospectively. Now under the previous gap, the mutual funds were measured at a cost or market value, whichever is lower. Under Ind AS, company has designated these investments at FVTPL. Makes sense? Because for me, mutual fund is a financial asset now. I got a contractual right to receive the cash. So I have to take it as a financial asset. And since I am holding it for trading purpose, my purpose to hold is as an FVTPL. The value of the mutual fund as per previous gap was 2 lakh as a current investment. Okay, in the current investment, can you see current investments there? 18 lakh includes this 2 lakh and the fair value is 2,30,000. So if it is a fair value, then that additional I can adjust to the retained earnings. Ignore separate calculation of the deferred tax on above adjustments. See, they said wherever deferred taxes are applicable, okay, forget individual calculation. Assume the net deferred tax impact is 50,000 on account of transition. Where all deferred tax impacts are going to come, no? Previously they said ignore it. Now they said net on net basis you move with the 50,000. So what we are supposed to do here? Recognize deferred tax asset with increase in the retained earning because it is a net deferred tax income, they said, means deferred tax asset. And if you have got a deferred tax liability, you offset. Now required to prepare the transition date balance sheet of Shaurya as per Indian accounting standard. No sure explanation for example for items presented by the CFO which may or may not require adjustments. If they don't require adjustment, you have to tell that it doesn't require adjustment. Okay, so one by one item we will go and see whether you have understood, you have got any doubt. At the end it should be very clear to you because it's a very lengthy question, so many things are there. You see after this, are you very clear with the explanations? First, disclosures of financial statement. You have to prepare the balance sheet as per Indian standard, no? So first you should give a disclosure there. In the notes to accounts, start first disclosure. Proposed dividend is subject to approval of shareholders. Not a liability. In bracket you can write not a liability. So first you start with one note telling that the proposed dividend is subject to the approval of the shareholders. So any balance sheet, if you take, you know what is the first notes to account? They start with the notes to account, no? What is the first thing they write? If the board of directors are proposing dividend, no, that dividend they will write. So that investors are very happy to see that dividend note. And then it goes to the notes to accounts 1, policy choices, investment property, one by one they start explaining things. So generally the first note will be the proposed dividend. Okay, so you will give one disclosures forming part of the financial statement. Yes, it is not, and you can give it in the bracket, it is not a liability. Okay, first we will go with the property, plant and equipment. We will go in the same CFO's notes, because question says what? Show necessary explanations for the CFO part. So I will go with the CFO. First, what CFO told about PPE? As per 101, entity may elect to measure item of PPE at fair value. Such option is on item to item basis. It does not mean that if I have selected a fair value for one, I have to select fair value for all. Other item I can choose for retrospective. But point is, it is not deemed cost of the previous values. If that was the case, then your previous balance sheet PP value and new balance sheet PP value would have been one and the same, other than shift from the policy. Deemed cost also you can shift, but you can shift. Alternatively, what it can do? Apply previous GAAP book value as deemed cost for all PP items. This is what your Ind AS 101 says. Are you clear? So you will write this story. Please check in the examination. You can short this, you can do it. So okay, in the given case, what happened? Company opted revaluation. For office building. Assumed other assets. Retrospective applied book value is equal to fair value of rupees 10 lakhs. So in the given case, what did you do? You have opted for revaluation of the office building. So from 10 to 15 you want to recognize. So there are 5 you will recognize in the revaluation surplus. And you have to make an assumption that what about the balance 10 other items of the PP? You have assumed that they must have gone for retrospective application of the cost, and that value is equal to today's book value of 10. Or they must have applied fair valuation for others, and its fair value today is it equal to its book value? Because the question was very silent. Are you clear? So this is your explanation for the PP. What is my second item about the CFO? Intangible assets. 1 minute, in which order I give? Okay, we can write about intangible assets. Second, intangible asset I have given in the third one. As per 101, previous book value can be elected if business combination is not restated. Oh, sorry, I am writing about this. As per 101, previous book value can be elected as a deemed cost. So that means all the intangible assets of the previous book value would have been shifted here. But this is different from your PP. That means, can you make such election? That PP I will go item wise item, but intangible I cannot go. Yes, you can do. Investment property, yeah. But in investment property there can be many. No, anyhow, investment property not applicable, revaluation not possible. Next, are you clear about this? This is, you can measure the previous value. Next, what is the item? Goodwill. Okay, right? Item number 3, goodwill. So what you do with the goodwill? Ind AS 103 need not be retrospectively restated. So previous book value is adopted. You need not restate the business combination retrospectively. It's an option. Again, intangible asset was also an option. PP is also an option. But what options are given, or when options are not given? ESOP is an option, but option is only for the vested one. If you don't want, then fair value change is going to happen. What is the next item? Are you clear now? You did not apply it, so it can continue with the previous book value. We'll go with one by one. What is the next item of the loan, right? Okay, so next one is we have done with the goodwill. 3, yes, trade receivables. So trade receivables, there is no change. As per Ind AS 1, estimates shall be consistent in Ind AS as per previous GAAP. So as per Ind AS 101, as per Ind AS 101, the estimates what you make should have been consistent in Ind AS as per your previous GAAP. New informations if you get, like for example, you came to know today that its fair value is 25,000. Shall not be reflected in transition date unless it is an error. Actually, the situation was like 20 only, 25 only. You made a mistake. Then Ind AS 8 becomes applicable to you. It will say that if there was a mistake, means actually your provision there was a mistake. Now how do you know that it is 25? Because you did one exercise now. Now one new information came to you. But if this was the truth earlier only, and there was one mistake happened, then you could have changed it. Otherwise, no, you cannot change. It's considered as a non-adjusting event. This change is a non, because now only you came to know. Yeah, I'll show you. I'm writing the short here, very short thing. Thus, it will be adjusted when? In 2018-19. It will be adjusted in the prospectively. It is not adjusted retrospectively. So you say that when it comes to trade receivable, your estimates in Ind AS cannot be different from the previous GAAP. And if you receive any new information, like you understand today fair value is this, first you will check how did we miss it, or did it happen because of any new thing now. So it shall not reflect the transition date unless it is an error. And so in the given case, they said it is 25. What you will assume? Is an error? No, you came to know now only some due to some exercise. So it is prospectively it will be applied in 1819. In non-adjusting means non-adjusting for, see, not 110, it's the non-adjusting for your, okay, when did you carry out the, what is it called, this farewell exercise, when did you carry out? Maybe today, okay. Now, will you apply it retrospectively 1 year back? Then it is an adjusting event. Here adjusting, non-adjusting is not from that Ind AS 10 perspective from 1st April to your board of directors approval. Here adjusting, non-adjusting is, will I adjust first opening balance? Today, are we going to adjust 1st April or are we just going to adjust only the comparative? So that we are looking here. Followed, no? See, because when we are preparing the opening balance sheet now, 1/4 whatever, is it an adjusting for this? No, that's what we are telling. So don't go with this word non-adjusting, because you may try to mix it with the 100 Ind AS 10 subsequent events. It's not that non-adjusting we are telling. Okay, we can remove, I will remove this. So it's a new yeah, today you are preparing 1st April 2018 balance sheet. So are you going to adjust it? No, you will touch only the previous year compare. What is the next item? Loan. What you will do with the loan? As per 101, as per Ind AS 101, if it is impracticable, because see, loan we never came across, no? Always we came across government grant, we came across compound instrument, equity and loan, government grant with the loan. What if it is a purely loan? Now, as per 109, if it is impracticable to apply EIR retrospectively, the fair value on transition date can be taken as new book value. We will give you an option. I don't know whether this option I have told in my theory or not. You are told, no? So it says that, look, the option goes like this. One is compound instrument between debt and equity. Another is compound type of instrument between government grant and loan. That we discussed very clearly. Now this is on pure loan, where transaction cost has been adjusted. Now can you go back to the EIR and change the EIR and find out the balance today? If yes, do it. No, I will give you an option today. I will not permit you to take the book value of the previous one, that is for sure, because the transaction cost has got adjusted there. Means you didn't consider only. What I will give you is to take the fair value today and take it as a new book value. Accordingly, rupees 50,000 is taken as new book value. Difference of rupees 10,000 is adjusted with retained earnings. Now you consider this book value with the contractual cash flows. That way, you are going forward your next year. You have to prepare one amortization schedule. What is your opening value? 50. What was your previous values? 40. So now you got 50 and this should become 0. You remember the first question where there was a 1 crore rupees loan, you will repay in 1.25. In next 4 years are left now. So what you are going to find out? You are going to find out one EIR where redemption value is whatever 60 divided by 50 to the power 1/4. Take that and you prepare one new amortization schedule and start with the new amortization schedule from now on. Alternatively, if you knew the EIR, you could have restated and you would have continued with the original amortization schedule, and the difference between the new book value and the book value present there, you would have taken to the retained earnings. Are you clear? Sorry? No, they have not asked, because That's what no management said, we cannot do that. That's why, no. When you have to prepare, see now if they say prepare a P&L like restated P&L for 18-19, then you need one amortization schedule for this. But what they asked, give me the restated opening balance sheet. No. For my opening balance sheet, this amortization schedule is not going to come. Understood? Yeah, I understand, students. See, this is a very vast. Only my suggestion is whatever we do here, because the chances are 90% that this is going to come, which I am going to show you. I have shown you. Now, have you understood this? When it is going to happen, what is going to happen, what type of option was given to you? Enough. Do it properly. High chances same thing is going to come. So, we have to just take 40,000 here, 50,000. Next is the government grant. As per 101, proceed prospectively. Unless original period information available. See, if you know original information when on the day you have taken the loan, then what you can do? One minute. Okay, this part is clear, no? I'll just 1 minute. Okay, I'll just show you the theory. Okay, so as per 101, the first time adopter shall go prospectively to the government loan and shall not recognize the corresponding government loan as a government loan. Don't do it. You remember the first question, what we did? Did we split that? 1 crore was there. You have to, in 4 years time, you have to pay 1.25. Did we split that? No. What did we do? We did 1.25 divided by 1 to the power 1 by 4. 5.74 is the EIR. And we took 1 crore value and we amortize it over next 4 years. Correct? Second question, again VAT deferral loan came. What did we do? We split the grant and loan. Why? Because information was available. So, why information was available? Because it just happened 1 day before that loan came to me, 1 day before my transition. Now, in this question, have they told you when the loan was taken? Do you have all the information to classify into debt and the government grant? No. Then you will opt not to split that into government grant into loan. So, they say that as per 101, first time adopter shall apply the requirements of 109 and 20 prospectively to the government loan existing on this date and don't recognize corresponding benefit of the loan. That means don't split. Then what you should do? Thus, you use the previous scanning amount on the transition date as the opening balance sheet value. Prospectively means continue this and go with the prospectively means whatever balance was there. See, this is the language. What they intend to say is whatever balances are there, you continue with that and don't recognize the government grant. No, not supposed to consider. How much is the difference here? 1 minute. Let me check the balance. No, but out of 4 lakh, see, if you look at the balance sheet, 4.5 is the book value, correct? In this book value, can you tell me how much is the breakup into government grant and loan? You are telling me this entire grants, loans fair value you are telling, but what I should do with the fair value? But that split is not permitted to me now. If you want to split, do the split on day 1, not today. I don't know, no? You are not having a period, no? I agreed. You must have been calculating, trying to figure out, but we need not get into that exercise. Question is very silent. Have you understood the difference now? See, this is the third question where we are coming, where in the first question, they went prospectively. What do you mean by prospective? Prospective means no split. Whatever book value is there, you continue with that book value. Second question, prospective means that's what they mean to say prospective. And deemed cost, go, no split. Do you want to split? Don't split today. Split on the day you took the loan. Now the second question was framed in such a beautiful manner that they said the loan was taken one day before the transition date. That's why they splitted it. So you got into confusion. You always started to believe that I have to split now. But it doesn't go like that. It says that if you want to split, you have to split on the day you have taken the loan. In this question, have they told me when the loan was taken? They didn't say. Then what I will do? I will assume to go it prospectively. Prospectively means not to split. No. Do you find this theory? Thus, it shall use the previous cap carrying of 450 as the carrying amount of the opening in this balance sheet. That means there is no split happening. No, you must be talking about this theory. No. Okay, maybe I have to change this. I'll just check this. I'll check this. Okay, understood. Yeah. Maybe I may have to change this. Okay, I'll change that chart book also. So here you have to, again, we have already seen 3 questions now. We have understood what the standing institute is taking. Okay, so now if this you have to write, no, maybe yeah, it's my mistake. The chart book, no, I would have given that sentence. I will change that sentence. Yeah, you are from the chart book language correct. What you said is correct. So we are not going to go for a split. Next is the mutual funds. Okay, what to do with the mutual funds? Entity, can you change, is permitted to designate previously measured financial asset as FVTPL, because you must have carried out some exercise. In the given case, mutual fund can be designated at FVTPL and measured at rupees 2,30,000. One minute, of rupees 30,000 in retained earnings. Yes, tell me what is your doubt? No, see, mutual funds are generally you are holding it. What is your business model? Hold to sell. No? Generally, mutual funds, okay, are the short term investment. So we can reasonably assume to be FVTPL because you cannot prepare an amortization schedule for, or we can also, sorry, fixed interest. Generally, mutual funds are for equity market, no. So that we can, because even though mutual funds are meant for your debt mutual funds, can you prepare an amortization schedule? No, then FVTPL only. FVOCI option is not available. Okay, are you clear about this? Mutual funds can be redesignated. Okay, now I'll give you time. Please again go through the theory, because after we finish all, then you need to be very clear. Yes, is there any more item? Deferred tax liability. So, net DTA is recognized for rupees 50,000. So instead of, they said, instead of you doing this exercise on individual item, you recognize deferred tax income, so which is nothing but an asset for me with corresponding effect to retained earnings. Clear? So net other leg will go to the deferred tax liability, and the last one is the provisions. There is one reversal. 8 provisions, dividend declared or dividend provided to be reversed with corresponding effect on retained earnings. Okay, students. So now please pause the video, go through all the notes what you have written, check with the question. Have you understood that what we have done, what adjustments we have done? Because we had discussed so many things. Now you see whether, read the note, read the theory what we have written. Does it make sense to you? Yes, sure. So you can, again, online students, you can go into the study material also and see that when it comes to government loans, see, there are only two things. Government loan, either you treat entire value as a loan, that's it. No split is required right now. Or you give a split, government grant and loan, but with a retrospective effect right from the beginning. Today's day, you cannot split it. Okay, so this all theory is okay, no? So write one working note number 1, calculation of the retained earning adjustment. How much adjustment you need to do for the retained earnings? Can you tell me the total, students? Yeah, please do this adjustment. Say for example, loan fair value adjustment. I will write the first item. I will not write the opening balance, because opening balance is there in my balance sheet of retained earnings. Certain debits, credits are going to come now because of all the notes what we have written. At the end, on cumulative value, I will adjust with the opening balance. I will get the closing balance. For example, if I go loan at a fair value adjustment, am I going to add or deduct? What was your loan at the note? See, it is a loan given, right? Loan given is a financial asset. So its previous value was what? 40. Now you want to increase it to 50. That, so will you debit retained earnings or credit retained earnings? If it is loan taken and the book value of the loan is going to increase, then you will credit. No? Is this loan given or taken? Is the loan given? It is your asset. What is the book value? 40. Now 50. So what accounting entry you are going to pass? So what entry you will pass? Debit what? Debit what? How, students? Let us go back. First of all, it is the loan given or loan taken? So what is the loan given? Its book value. Company had a given of loan of 1 lakh rupees 10 years back. Clear? No. It is a loan given. It is your financial asset. So your book value of the asset is 40. Now you want to make it 50. So debit asset, credit retained earnings. So you have got a credit of 10. Like this, can you do, tell me from all the notes to accounts, wherever retained earning adjustments are there, can you tell me the debit and credit and total adjustments? Can you tell? Yes, students, please pause the video and do this. Yes, students. So we'll compare the answer. Okay, after this adjustment, because this is a prime adjustment, from there we will start with the balance sheet. Okay, we'll again just go through so that any confusions are there, it will go. Increase in the mutual fund, did you take 30,000? Yes. Decrease in the deferred tax liability, 50,000 is credited. Deferred tax. See, what they said, do you have to recognize on a cumulative basis for all the adjustment, deferred tax asset or liability? What entry you pass? 2, that's what we credited to deferred tax. No. In the balance sheet, how much I have got deferred tax liability? Okay, so going for, okay, now I will get 1 minute. You have got a deferred tax liability of 3,50,000. 3,50,000 is there. Now 3,50,000, how much is your deferred tax income? 50. So will you show on the asset side deferred tax asset? No, you have to net off. So going forward in the balance sheet, deferred tax, net deferred tax liability is 3 lakhs. They said, see, you have done so many adjustments, rather than individually figuring out what is my deferred tax asset or liability, they say cumulatively all this adjustment has resulted into 50 lakhs rupees income. So your accounting entry is deferred tax asset account debit to liability. But when you present, will you show deferred tax asset in the balance sheet? No. Already liability was there, you minus, so you will pass one more entry, or you will pass the entry deferred tax liability to in retained earnings. Are you clear? Then you have got the decrease in the provision for interest dividend 2 lakh. So if someone added openings balance of retained earnings as per the opening balance sheet, you would have got the closing balance. Now PP revaluation surplus, what you will do? It is a revaluation surplus, no? It is a separate presentation, no? It is not a part of retained earnings. That's what I am trying to tell you, that the previous question what they have done, that is a very different thing. I don't know what adjustment they have done, or maybe there is a specific provisions there. So you have to bifurcate. You cannot show here, you have to show in the balance sheet as a revaluation surplus. Which one? In the next year, P&L, not in the retained. Means it will get added of 31st March 2019 retained earning from the P&L. Okay, students, we'll do one thing. I'll just explain to you again. Okay, if any confusions are there, should be very clear. Okay, now we'll quickly have one recap. Anything you miss, you can discuss. Now you moved to Ind AS financials when? On 1st April 2018. They gave you accounting standard balance sheet. Then they have given you in that deferred tax liability is already sitting here 3,50,000. Followed, no? And you have given long term loan, this one goodwill also is there. Okay, so many items are there. Then comes the first set of adjustment. Remember, all these adjustments are reclassification adjustments. These are not Ind AS 101 adjustments. Means 101 only, but it's a simple reclassification. So that's why we didn't give any notes to this, if you observe. Followed? Because question also silent. It just split this into 2, split this into 2, split this and present separately. Followed, no? Like there was a financial liability, non-financial liability. Financial liability, non-financial liability. This was entirely non-financial. This has to be, loans has to be separately disclosed. That's why we didn't give any notes to accounts for this or explanations to it, because question also was not asking for it. Other expenses include some assets, so this also financial, non-financial. Maybe in the exam they may remove this entire portion also. Life becomes very much simpler now. And there is one provision which should be reversed. This requires one note. Follow? Okay, are you clear up to here? So this is all the 5 adjustments except the 5th one, because this is the one which is going to hit your retained earnings. Why? Because they made a provision. Provision should not have been made. Reverse the provision. Now comes the CFO. for which you have to write the explanations. Now CFO proposes certain things, like he says that I want to do the revaluation of the land, office building. Can he do? Yes. That means which model you are following earlier? Probably cost model. Now from cost model, have you wanted to entire cost to cost you want to move? No, you wanted to do one item's revaluation. That means all items you should have gone. Other items we say that you must have gone, leave it. But when you moved from cost to revaluation, any difference will go to the revaluation surplus, because there is a change from cost to the revaluation model. You didn't took that value as it is. Now immediately you will ask me, sir, in the previous question we shifted to the retained earnings, that land value. Again, I don't have any explanation, because that's what they have done. They should have moved it to the retained earnings or revaluation surplus separately, not to the retained earnings. Okay, I can say it's an inconsistency. But exam also we have seen what they have done is the same thing. So here what we need to do, we have to recognize this 15 and transfer. Then they said intangible, I don't want to do revaluation. Are you okay? Yes, our note number 2 that we are okay with intangible, there is no adjustment required. We want to go with the cost only. Then I went to the third one, they said that look, we didn't do the fair value exercise for goodwill. We said okay, you can proceed with the old book value of goodwill, provided you don't touch that one business combination. Then they said there is a 20,000 to what is that called, RBD was there, reserve for bad debts. This should have been 25,000. Then we make an assumption that this was not an error. So opening retained earnings, no adjustment is going to come. This is going to get affected from 2018-19 P&L, 19-20. Then comes a loan given, a financial asset. Now the standard says that look, when you have given a loan, you go for retrospective change. Because you made one mistake here, it's because I don't know, it's not a mistake. You must have accounted this transaction cost to the P&L and charged based on the market rate or a contractual rate. But what I want you to find out is one EIR and find out the balance today. Alternatively, I will give you an option. If you don't want that EIR, go with the fair value of the loan. So my fair value was this. Oh, sorry, fair value was 50,000. Your book value was 40. So here one retained earnings adjustment is going to come. Retained earnings account debit to, your financial asset account debit to retained earnings. Okay, but this is because of the option what you have chosen, not to retrospectively restate. If you wanted that, then you wanted an EIR. Then comes the long-term borrowing component for the state government. This is government loan, which was creating all confusion till now. Maybe my one sentence in the chart. Now the standard says only one thing here, and it is a very crucial here, because two different places, two different adjustments we have seen. Standard says, look, this loan, do you want retrospective? Go to the date of the loan, and from there you do give a split. And then you find out what is the value today, and then you do the adjustment. Alternatively, what was the book value of the loan today, you continue as the book value of the new loan without any split. That means government grant is sitting there, but don't recognize it. Now in this question, fair value is given. You have to ignore this fair value, because this option is not there to shift into the fair value. Option is either retrospective restatement or continue with the book value, not shift to the fair value. And what they have opted here? Opted for the previous book value as the new book value. No split there. Why? Because they didn't tell me when the loan was taken. In the second question, loan was taken one day before. Then mutual funds were my assets, financial assets. Can I designate into FVTPL? Yes, we can designate, and there is an increase. This becomes one retained earnings adjustment, because there is a profit. Retained earnings is going to get credited. They said defer separate calculation for individual items you ignore, and net income on account of transition adjustments only is 50,000 rupees. So my accounting entry is deferred tax asset account debit to retained earnings. But this deferred tax asset, when I show in the balance sheet, I have to net with the DTL. If DTL was not there, I would have shown deferred taxes. In total, are you okay? Then we started to give all this explanation, and what they said give the explanation to the CFO's questions in the form of notes to accounts. So logically, how should I have prepared? How should I should have gone with this in the examination? In the examination, I want you to leave first 2 pages blank. I want you to leave the first 2 pages blank. That is because you have to start with the balance sheet as per Ind AS. But here I cannot do it without explanation. I cannot show you. No. In the exam, I want you to write the heading balance sheet as per Ind AS. Leave 2 space blank. Write notes to accounts. The very first notes is the directors have declared dividend which needs to be approved in the AGM. Any balance sheet you take, first notes to accounts is this. Then comes note number 1, PP, which is an explanation to the CFO's queries only. So in that note only, previously in which format I gave the note was in the note to the balance sheet format, like PP was there. I saw, is there any query of the CFO? I said that is note number 2. Goodwill, note number 2. Is there any query related to goodwill? Note number 2. Intangible asset, note number 3. You can do that way also. You can go to the item of the balance sheet, check is there any query, give that as a note. Otherwise what happens? If you go in the order of the CFO's query, when you present the balance sheet, note number will get mixed up there. 1, 2, 3, 4, 5, 6 will not come in the fashion what you have done. That's okay. If you want a beautiful note number 1, 2, 3, 4, 5, then CFO's queries will get mixed up there. CFO's query number 4 is related to goodwill there. That is going to happen, that you choose, followed, no? Then we started, okay, what I have chosen now? I have chosen to, okay, first a disclosure, this is what you need to give, this sentence should not come there, should not be recognized as liability and all this is that we have proposed a, what is that called? We have proposed a dividend which you need to be approved in the upcoming AGM. Then these are all the notes we gave, explanations, what is approved, what is told in the Ind AS, what we have taken, correct, no? Which I have given you in the short. These are all the explanations we give. Then did we one working note. This will come at the end. And after this, you will go to the first page and then start preparing the balance sheet. Have you understood the way? And this way you have to practice it. You can do it, not an issue. Like in this fashion also you can go and do at the balance sheet at the end. But the presentation will be not in the form of how do you present it to the investors. That's why if you take any suggested answer, first thing they start with the balance sheet, then with the notes to accounts, then with the working note. But that way I cannot prepare, no. This working note I have to prepare before I prepare a balance sheet. That's what you prepare a format now at the top. Then go with the notes to accounts, whatever this, and go and backfill the format. Otherwise, leave the space. No, 1, 2 pages you leave space. Or you start with the balance sheet format, because balance sheet format, you know, you understood no strategy how to follow. Then no confusion at all. I hope things are okay now, comfortable. Yes, and see, wherever you need to change now, that I am going to change. So when I will give you the soft copy of this PDF, no, you will have only what is needed for, because so many explanations are there. I will cut short explanations. I will write what you need for exam. Just practice that, write it in the exam, because whatever you write, they will give you only 1 mark for 1 note. Whatever story you are going to write, I don't think so more than 1 mark there. Why you have to write so many things? Okay, so now are you clear with this 2,90,000 adjustment? Yes, now we will prepare with the opening Ind AS balance sheet. One by one item. See, now hope everything is clear with you. We'll come back to the balance sheet part. First, I will start with the non-current asset. Alternatively, this skeleton you could have done first. Written the notes there, because these previous balances are as it is, no. Only adjustment is going to come from the notes. Under this, I will go to the PP first. Tell me, what is my PP note number? 1. What was my previous value? 20 lakhs. Was there any adjustment? What was that adjustment? 5 lakh increase is happening. Where is the second leg? Revaluation surplus. So this balance is going to become 25 lakhs. What is my second item? Look in the balance sheet. No? Okay, as per schedule 3, what should have come? Goodwill. Goodwill should come before intangible asset and then other intangible assets. That will have breakup like masthead, the acquired rights, this research development cost and all those things. What is your goodwill? What is your note number? 3. That's the reason I told you. You can do one thing like PP1, goodwill note number 2, search whether query is there or not. That you see how you are comfortable. Otherwise, go to note number. Which one? See first, because we have addressed no one by one, we have understood it. So no, give the note accordingly. Then this is okay, right? It doesn't matter. This is just a reference. No, you can give it this way. No, previously I did note number 1, 2, 3, 4 like that. That's what I was shifting. No. Okay, how much is the goodwill value? 1 lakh. Was there any adjustment? No. Why? Because they have taken previous no restatement. If you feel comfortable, I feel good, students. Now third item is what? Other intangible assets. Note number 2. Because there was a query from the CFO. 2 lakh. The query was, I will not do revaluation. We said, okay, permitted. But if the same thing you would have told to that another factory building, we said no. Because office building you are revaluing. And there we made an assumption since the question was silent. Done. What is my next heading? Non-current assets is the main heading. In this fashion, financial assets. Underline. In this column only, because under non-current assets is financial asset. Which is my first financial asset? Investment. Is there any investment? 5 lakh. Was there any query on the non-current investment? You had an investment query, but it was a mutual fund, current. No. So we didn't give any note only. So whatever previous balance, it is going to become new balance. Do I have any other non-current investments? Yes, there was one loans, no? Loans and advances. So how much is your loan? Because as per schedule 3, I have to give a separate disclosure. What is the loan? 40,000. Out of this 40,000, how much I am going to adjust? 10,000. So what it was for loan advance, which was the note number? Note number 5. This is the loans given. I have taken one loan given, no? So that plus this total becomes 50,000. You have got other financial assets. See, non-current assets, financial assets, investment and loan you should show on the face as per schedule 3. Whatever others are there, you fix in other financial assets. What is the other financial assets do you have? Do you have any other financial assets in the balance sheet which we have left under non-current? Now, out of long-term loans and advances, loans we have taken 40, right? And that we reshaded. So how much is balance now pending? 1,10,000. See, under you can write in the bracket 1,50,000 was the total long-term loans and advances. 40 I shifted as a loan as per schedule 3. We shifted here. Is there any adjustment for the balance? No. 1,10,000 dash 1,10,000. Then I'll go to the balance sheet, I see that other non-current assets. So other non-current assets will not come under financial assets, it will come under the last head called other non-current assets. How much? Okay, where the capital advance is sitting? Is there an adjustment related to the capital advance? Where the capital advance is sitting? Under current, no? Now how much is the capital advance? Sorry? 2 lakhs. That is this other non-current advance. It is not a financial asset. So you can write in bracket capital advance. They said there is one capital advance, no 2 lakh. Previously, I don't know, they have classified under something. But for us, it is not a financial asset. But it is current or non-current? Non-current, because it is a capital, maybe due for more than 1 year from now. So it will be placed next to the financial assets. Have you understood this? This becomes 2 lakh. Nice question, because see, they have mixed here. One is your Ind AS transition adjustments plus Ind AS 1 adjustment classifications. That's why it looks so tricky. But if you look, it is a very simple. If that classification problem would not have been there, it is a very simple, no, what we have done previously. First, that balance sheet problem. Now I'll move on to the current assets. Non-current we have done. The first current assets is inventory, always. Is there any change? 12 lakh 50. No CFO's query also, no reclassification also, 12 lakh 50. Next to inventory, what comes? Financial asset. Under financial asset, the first financial asset is investment. You have got mutual fund. In bracket, you can write mutual fund for your understanding. Generally, you don't write like this. You simply say financial asset. What was the note for mutual fund? 7. How much was the total investments? 18 lakhs. What was that adjustment you have done for mutual funds? 30,000 you added. So 18 lakh 30. And the second leg of this mutual fund is sitting in the retained earnings. And this adjustment is coming from the CFO's query. CFO query. After this, do you have any other? Trade receivable. Which note number? 4. Now how much was the trade receivable? 9 lakh. Is there any adjustments? On this day, not there. If you have prepared this financial statement at the end of the year, in the P&L account, that 5,000 rupees difference you would have seen. So next year, the reserve for bad debts would have been increased by 5,000 rupees, because it is a post prospective adjustment, not on the day of transition. Do you have any other financial assets? CCE. Is there any CFO's query? Is there any classification? No. So total 10 lakh will be 10 lakh only, whether you talk about Ind AS or accounting standard. Then you have got other financial assets. Okay, now let us go back to the balance sheet. Non-current assets we have finished. Under current assets, investments we have addressed, inventory, trade receivable. Other current assets, now look for that 4 lakh. They have said, go back to the balance sheet first part, classification, Ind AS 1 adjustment. In this 4 lakh, was there any adjustment? What is that? 50,000 is something sitting, no? Prepaid expenses 50,000, you minus 3 lakh 50. Is there CFO query? No, 3 lakh 50. And how do you show that 50,000? Other current assets. A prepaid expense is a other current asset. Other, not financial asset. And I am telling you, if this part was not there, simple, the first part was not there, that current non-current classification, no, this problem would have looked very simple and easy, just like today's first problem what we have solved, the problem number 3. Tell me, what is the difference between this problem and that problem? Same, but they complicated it little. How? That non-current current thing they brought. Done? Yes. Now we will move on to the equity and liability. So equity. Equity share capital. Is there any adjustment? No. Other equity. See, now this is one different thing they have done. So please see, I don't know how I should present it. On the face only they have given, okay, retained earnings. Working note number 1. See, I will tell what is my opening balance, 25 lakhs. You did one last working note, no, at the end. How much adjustment on total you have done? 2 lakh 90. What is your closing balance? 27 lakh 90. And fair value reserve or OCI revaluation surplus, opening balance was not there, 5 lakh. 5 lakh. Have you understood this? So my total equity comes to this. On the face of the balance sheet only, other equity breakup was given. Clear? Now, how they have presented it? ICI. See, they have presented it like this. They say working note number 1, retained earning balance. For whatever working you have done, they have added opening balance. And they created one more working note called other equity. And in other equity, they said retained earning balance is so and so. Fair value reserve is separate disclosure. It is 32 lakh 90. And in the balance sheet, they said only one. And they said this is your total other equity balance. Yeah, 1st April. No? This is on 31st March is nothing but closing balance. No? You see again, they said as at 31st March. It should have been 1st April. But don't trust ICAs. But you are clear, no? So it doesn't matter. See, max to max, risk is with 1 mark. So they are not giving us clarity how to present it. Leave it. Otherwise, if you want, you prepare one notes to accounts called other equity. Just like you have prepared notes to accounts up to 8, no? You prepare one notes to accounts for other equity. And we have done 110, we learned how to prepare that. You can do that way. Okay, now we will go to the liability portion. Non-current liabilities. Under this, first is financial liability. Under non-current liability, we will go to the financial liabilities. Under this, we have got long-term borrowing, first one. Because what? There was no classification previously. Simply they said long-term borrowing. But we will call long-term borrowing under, what is the note number? That's the CFO query, no? 4,50,000 rupees, that government loan and all. 6. 4,50,000. Did you split this? No, in the previous question we did minus government portion and recognized it as a deferred government income. Why? Because we opted for retrospective change. In this question and in the first question, we didn't opt. That's why we didn't give any recognition to the fair value. We took the previous book value and we continued with the book value, but going forward, we are going to amortize with the EIR. This 4,50,000 from now onwards, I don't know what you have been doing. You have done so many things, government grant is sitting, leave it. From now onwards, this is like 1 crore. This will be repaid with 1.25 crore. So did you not prepare an amortization schedule at 5.74% from 1 to 2? Same treatment I am going to give to this 4.5. This book value of 4.5 is going to get amortized over next term, whatever it is. 4 years left now. Clear? The first one, first problem what we have done now. Is a repayment. Okay, next, do we have anything else? Long-term provisions. Will it come under financial liability? No, it will come as a provisions. Is there any query of the CFO? Is there any reclassifications with the long-term provisions? Short-term provision is the dividend paid, you have made some adjustment. So 3,50,000 dash 3,50,000. There is no adjustment related to the long-term provisions. It's a dividend, no dividend provision was there. Then what you have? Deferred tax liability. You write in the bracket net. What was my note number? 8. Opening balance was 3,50,000. What was the adjustment? 50,000 minus deferred tax asset. Now clear, Dhanashree? If this was not given, on the asset side you would have shown under non-current assets. You should other non-current, not other non-current assets, a separate presentation. Because you cannot put this under non-current assets, other assets. So like this we have prepared the non-current liabilities. We will move on to the current liabilities now. The first current liability is what? Financial liability. Second subheading. Under financial liability, always I will give trade payable. See, under current financial assets, first heading is inventory, then trade receivables. When it comes to financial liabilities, current financial liabilities, the first heading is always trade payable. Like again in that, due to MSME, due to others I have to give as per schedule 3. But here question is very silent about due to MSME. Trade payables are financial liability. No? Like debtors, you have got a contractual liability to obligation to pay cash, right? If you are given advance to the trade payable, that is your current assets actually, other current assets, not your financial assets. So how much is your trade payable? 22 lakhs. Is there any adjustments, changes, mistakes? No. 22 lakhs. Yes, Sana, what is the doubt? Trade receivable is a financial asset, no? But current financial assets. Receivable, no? You have sold goods for which you are recognizing trade debtors, no? And for these people has supplied you goods. In return, what you will give? You will pay cash. Yeah, don't mix with them. Understand very clearly. Debtors and creditors are my financial assets and financial liabilities. Because debtors have sold the goods, I have got a right to receive cash. Creditors have purchased goods, whatever obligation to pay cash. Now, what I have got next now after this long-term trade payables, other current liabilities. Okay, so other current liabilities, how much? 4,50,000. Now go to that current non-current adjustment, first part. Is there any adjustment? Is there any financial liability component in other current liability? What is that? Something 3,90,000 is there, no? What is the 3,90,000? Expense payable. So I will call it, will I write a separate heading? No, schedule 3 has not given me that. Schedule 3 has got given me trade payables, maybe loans or something, then other financial liabilities, because it's current only. Other current liabilities which is non-financial, but you don't say other current non-financial, that description you will not use. Other liabilities means, other current liabilities means non-financial only, because if it was other, then other financial liabilities you would have said. Are you clear? 3,90,000. 3,90,000. Then what is that 60,000? Statutory dues. Is it financial? No. Is it current? Yes. So you say other current liability. How do you see? Do you get that clarity now? It is the other current liability, but it is not other financial liability. But it is current only, but it is not financial. So you have to get used to this to solve the problems from analysis of the financial statement. So how much? 60,000. CFO's queries are not there. That's why you see, you bifurcate this question into two. One question is on Ind AS 101 adjustments. And second one, they complicated it by bringing Ind AS 1 adjustments. One is not a 101 related headache there. It's just a reclassifications. Like land to investment property. When there was only one, there was no headache. But this, no, other current, non-financial, that is going to create a confusion. So now I have got a provisions. Note number 9, dividend related. How much? 12 lakhs, short-term provisions. Is there any adjustments? Yes. 2 lakh reversal I am going to do. It is 10 lakhs. Thus, we are going to prepare opening Ind AS financial statements. Are you clear, students? Okay, now, perfect with everything. Okay, what I'll do, that theoretical note part, no, I'll make certain adjustment so that you can quickly write what is required for the exam. And your strategy is, first you write the skeleton for this, then go to the notes, start doing notes as per the CFO's instruction. No, you know this, no trade payable, financial liability, even though you don't want to do this adjustment. See, again, if this question comes, I already told you, in the pencil you can do, no, Baba. Do you need to add a column there? Not required, no. In pencil, in the brackets you do, and give the notes there. Follow, no, don't draw the column. You write column like this, particulars, note, Ind AS summary, enough. In a bracket, you can always write this. Otherwise, you can write it, because in the study material, in RTP, MTP, everywhere they have written it. So, Ind AS 101 means you can do it like this. No, I am telling you, high probably it may come, at least 15, 16 marks it may come. The only your challenge will be, as far as me, your challenge is with the current and non-current. Leave it, no. How much mark they will deduct? They will deduct mark for this, they will deduct for this. Max to max 3 to 4 marks they can cut short for this. But your majority marks will come from 101, right? Okay, students. So now we will discuss some of the theoretical parts.